Introduction to bond funds. Bond funds are investment funds that primarily hold fixed-income securities, such as government and corporate bonds. These funds provide investors with the opportunity to access the fixed-income market by pooling their money with other investors. Bond funds are managed by professional fund managers who make investment decisions based on the fund's investment objectives, the interest rate environment, and the credit quality of the underlying bonds. Understanding the basics of bond funds. Bond funds can be broadly categorized into various types, including government bond funds, corporate bond funds, municipal bond funds, and high-yield bond funds. Government bond funds primarily hold bonds issued by governments, while corporate bond funds invest in bonds issued by corporations. Municipal bond funds focus on bonds issued by state and local governments, and high-yield bond funds invest in lower-rated, higher-yielding corporate bonds. Benefits of investing in bond funds. Investing in bond funds offers several advantages for beginners. Firstly, bond funds provide diversification, allowing investors to spread their investments across a broad range of fixed-income securities, which can help reduce the impact of individual bond defaults on the overall portfolio. Additionally, bond funds offer the potential for regular income in the form of interest payments, making them suitable for investors seeking income generation. Risks associated with bond funds. While bond funds offer the potential for income and capital preservation, they also carry certain risks. Interest rate risk, which refers to the impact of changing interest rates on bond prices, is a primary risk associated with bond funds. Credit risk, or the risk of bond issuers defaulting on their payments, is another important consideration for bond fund investors. Additionally, bond funds are subject to inflation risk, which can erode the purchasing power of fixed-income returns. Selecting the right bond fund. Choosing the right bond fund requires careful consideration of various factors. Investors should assess the fund's investment objective, risk profile, credit quality of the bond holdings, and duration. Duration measures the sensitivity of bond prices to changes in interest rates, and understanding this concept is crucial for bond fund investors. Additionally, investors should evaluate the fund manager's track record and investment philosophy to ensure alignment with their own investment goals. Long-term perspective and investment strategy. Investing in bond funds requires a long-term perspective and a disciplined investment strategy. While bond funds offer the potential for regular income and capital preservation, they are also subject to market fluctuations and interest rate movements. By adopting a buy-and-hold approach, investors can mitigate short-term market volatility and benefit from the stability and income potential offered by bond funds. Bond funds and asset allocation. Bond funds are an essential component of a well-diversified investment portfolio. Asset allocation, which involves dividing investments across different asset classes, such as stocks, bonds, and cash equivalents, is crucial for managing risk and achieving investment objectives. Bond funds can provide stability and income generation, complementing the growth potential offered by equity funds and other asset classes. Tax considerations and investment planning. Investors should also consider the tax implications of investing in bond funds. Interest income from bond funds is generally subject to taxation, and investors should be mindful of the tax treatment of bond fund distributions. Tax-efficient investment strategies, such as holding funds in tax-advantaged accounts like individual retirement accounts or 401k plans, can help minimize tax liabilities and enhance overall investment returns. Conclusion: building a balanced portfolio with bond funds. In conclusion, investing in bond funds presents an opportunity for beginners to access the fixed-income market, benefit from regular income, and enhance the stability of their investment portfolio. By understanding the basics of bond funds, assessing the associated risks, and selecting the right funds aligned with their investment goals, beginners can build a well-balanced investment portfolio that addresses both income generation and capital preservation. Bond funds, when integrated into a well-structured investment plan, can serve as a valuable tool for achieving long-term financial stability and diversification.